Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in 45 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
I'm very good, Bryce. Very excited for this episode. And I know you always say that I say I'm excited. And look, it's because I love what I do. But I'm also excited for this episode because this was something that was really brought to us by our community. We'll do the intro in a second, but this is one of the first interviews that has really been organic. It's been a groundswell from our community. It's been an overwhelming demand for us to talk about this product and to talk to this CEO. So I'm excited to bring the community what they want to hear.
Absolutely. So I guess without further ado, we should be introducing the CEO of Sharesight, Doug Morris, to the show. Welcome, Doug.
Thank you very much, guys. Good to be here. That was quite the build-up. I hope I can.
Hopefully you can deliver.
Oh man, no one's ever been that excited about portfolio tracking and administration software before. I love it.
You should hang out in our Equity Mates discussion group because I'm going to say there are people that excited.
Right, it's all about big fish, small ponds. That was a lesson I learned a long time ago. So.
No, likewise, Ren. I'm keen to get stuck into this one. It's been in the works for a while, so good to have you on the show, Doug. Just a bit of a background on Doug before we jump into our classic opening overrated, underrated game. Doug's obviously, as you can tell by the accent, born in the US, started his career at Chicago Board of Trade and then spent 5 years at Morningstar and joined Sharesight in 2013, which we will obviously delve into a bit, and has since been promoted to the role of CEO in 2015 and remains there today. So quite a journey that we'll delve into a bit. But Doug, I'll throw to Alec because we always like to start with a bit of a game to warm us up.
Cool.
That's it. So we call this game overrated or underrated, but it maybe should be called overvalued or undervalued. Essentially, we throw out different investing themes, topics, indexes, and we like to get our guests' thoughts on whether they're overvalued or undervalued, just to get a sense of where your thoughts are around some of the hottest topics in the market today. So are you up for playing?
Let's do it.
Okay, so to start off local, overvalued or undervalued the ASX 200 index?
Overvalued.
Even after the couple of weeks we've seen.
Even after the couple of weeks. I would encourage you to zoom out a little bit more and have a look at that chart and just kind of put it in perspective. But I think it's a bit overvalued still. Yeah, I do.
I've been doing a lot of that recently, of going to the 3 to 5 year chart and reminding myself that things are all okay.
Yeah, absolutely.
I guess then that sentiment would carry to the S&P 500, overvalued, undervalued?
Yeah, there again, I think it's overvalued, even more so. I mean, if you look at the underlying companies in the S&P 500, there's so much more tech contribution in the States than there is in Australia. I think the Aussie ASX 200 is like 2% of the market cap, I think, or maybe 2% of the underlying revenue is from tech companies, probably market cap. And then I think in the US, it's more like 20 or 25% of the market cap. So if you take that into consideration and you know what tech stocks have done, then the S&P 500 is going to be more overvalued even than the ASX 200.
So, Doug, we're recording this podcast on the 10th of March for people to put it in perspective. We've had a couple of weeks of panic selling across the world. We kicked off the week with a 7% drop in the Australian market, followed by 7% drops in a number of markets overnight. Tuesday, the day that we're recording, the market was relatively flat, but there's definitely a lot of panic out there around the coronavirus. So with that context in mind, overvalued or undervalued the coronavirus's impact on the economy?
Oh, man. It's probably overvalued. I just think that the way that information is collected and disseminated these days, everyone's got a story about it. Everyone is kind of threading that into their daily life. As I do this podcast from my kids' rumpus room, I'm stepping over rolls and rolls of toilet paper that my wife has amassed. And she's a very rational, level-headed person. So I would say probably overvalued, and I guess I hope I'm right about that, because it's certainly a scary thing and something to be taken seriously for sure. But like you mentioned, the falls we've had over the last I don't know, week and a half or so of trading sessions. But then the ASX was back up, I think about 3%. I just checked this evening, and it's had its best day in 3 years, just on a daily basis. So the volatility, I think, is here to stay.
So you mentioned before we were recording that you've just made a fresh move to the northern parts of Sydney. So overrated or underrated Australia's housing market?
Oh my God, I have to say overrated, because I'm still thinking about the price we paid for our house, and I'm thinking about, I can't help but compare that to kind of the Midwestern suburban lifestyle that I'm used to, and what like my parents and aunts and uncles and friends have all paid for their houses. So yeah, I got to say overvalued.
And then to close out the game, overvalued or undervalued managing your own super?
Oh, undervalued for sure. I think I'm really passionate about this, obviously, because I run a business that helps people track their investments, and we want more self-directed investors out there. But I learned this, we might get into this a bit later, but I learned kind of the value and the benefit of getting your hands into your own retirement savings in my first job at Morningstar. And it's relatively low stakes because you can't really touch the money until you retire. It's tax-free. There are certain limitations on what you can and can't do with it, depending on the plan or the super that you're with. And I just think more people ought to be encouraged to do it. I think if you look at these initiatives from the government to kind of have a one-size-fits-all super and all that, I think it's all well-intentioned. But paradoxically, the more control you give people, I believe, and the more hands-on you encourage them to be, the smarter investors they'll become.
Yeah, that's an interesting way to think about it. I like it's a low sort of risk game. Anyway, before we get into Sharesight, Doug, we always like to understand a bit about your personal background, and that always starts with getting the story of your first investment. So we would love to know what that was, sort of what led to it, and perhaps any major lessons that you still carry from that first investment through to today.
Sure. So my first investment was in high school, and that was shares in Disney.
And
yeah.
Still got them?
And no, I sold them because I made a stupid financial decision later in university, which I'm happy to get into as well, which might be a lesson for people on taking a credit card out from Walmart when you want to buy something dumb. But that's a different story. But
we'll get there.
Yeah, it was Disney, and I was part of a team in my econ class, and we enrolled in the teacher enrolled us in the state of Illinois stock market game. And we ended up advancing. I think we won our school and we won like our district, and I don't know, got like a free t-shirt out of it, but it was all in the back of our bet in Disney. And admittedly, we had done, what we thought was research, but it didn't amount to much, honestly. We were honestly just buying the brand because, as kids in high school, we were familiar with it. This would have been in the late 90s. So, we're familiar with the brand. And I think to carry that through to today, that plays into what's known as looking for companies with wide moats. This is a concept that was popularized by Morningstar. It's a cool concept, and it's easy for a lot of people to grasp. So a moat is like a defensive moat around a castle. And in this case, with Disney, their moat is their brand. It'd be classified as an intangible asset. But, if you think about brands like Disney or Coca-Cola or Tiffany's, for diamond rings or things like that, that brand carries so much cachet. And if you're thinking about making a long-term investment, it typically helps the return of that stock over time.
I like the fact that you invested in what you know, though. That's very Peter Lynch style. You were probably a user of the product, probably watching Disney, and you knew that they were valuable. So don't sell your research short.
Yeah, well, that is something that I still do today. I think knowing companies you invest in is really, really important.
So moving on from that first investment in the share market game in school, you went to college in Dallas, and then you started your career at Morningstar in the US. So can you tell us a bit about your early days in finance and maybe that story about that big financial mistake you made in college?
Yeah, sure. So my dad worked in finance, so I always had it in mind that was something I wanted to do. My dad, commodities trader in the Chicago Board of Trade on the trading floor. So he traded soybean futures mostly in the open outcry pits, which if you've seen that depicted in shows or movies like Trading Places, it's kind of the rough and tumble, everyone's screaming at each other and pushing each other around. That's where I started as a runner and as a clerk way back in the day, working for my dad and some of his mates down there. And then I kind of got a taste of that, and I wasn't quite into kind of the speculative nature of that industry, and also from guidance from my dad. He's like, yeah, you don't want to get into this. Most guys don't last for more than a few years down here. So I kind of went to the other extreme of the investment realm, which was kind of the staid world of like mutual fund analysis with Morningstar. But Morningstar is based in Chicago, which is where I'm from. So after a uni in Texas, I went back home. I got a job there, and I began as an analyst, really like a what they called a data analyst. And I was basically tasked with testing financial modeling software and assumptions. So it would be my job to say, okay, here's an individual earning X amount of dollars per year. Here's their risk appetite. Here's the mutual funds or managed funds, as we'd say in Australia, available to them. Let's play that out over 35 years and kind of what happens to the return and the risk profile and things like that. So unbeknownst to me at the time, it ended up being like a really solid academic grounding in asset allocation research and just really broad principles of investing.
And then, Doug, I think we would love to know the story about the big mistake that you made from a finance point of view at university.
Yeah, so what I did was I was with all my housemates at university down in Texas, and we decided that we needed some more entertainment in the place that we were living in. So on a whim, we went to Sam's Club, which Sam's Club is basically like a Costco. It's a wholesale, kind of bulk wholesale retailer in the States. If you've ever been to the States, you've gone to a Walmart. Sam's Club is like the gigantic version of Walmart. So it's like it's enormous in scale. And this is in Texas too, where everything's bigger. So we go in there and we decide that, it's a great idea to buy an air hockey table.
Nice.
So we all pitch in. Yeah, is air hockey a thing in Australia? Do you guys know what that is?
Yeah,
we know what it is.
We know what it is. I wouldn't say it's a thing though.
Yeah.
Right. Well, it's an awesome game. So, we all kind of pooled our cash together, and it came down to somebody had to, I don't know, we were short, of course, or something like that. And so when you join one of those wholesale warehouses, they make you sign up. And of course, this being the US, where there's very few consumer protections, especially in the financial space, they're like, hey, do you want a credit card with your subscription? And of course, when you're 20, you're like, yeah, sure, load me up, And there was like a $5,000 limit on the thing or something like that, which is just an astronomical amount of money to somebody who's in their 20s at uni. And of course, we put the air hockey table on the credit card, and I like failed to make a payment here or there, and got hit with finance charges and had to sell my Disney shares to fund my air hockey table. So I'm sure somebody out there could do the math and figure, okay, you buy Disney shares in 1998, carry those forward to today, or an asset such as an air hockey table, and figure out what the difference in return would have been over time.
Yeah,
so,
what would that air hockey table have compounded to over the life?
Yeah,
a lot of air hockey tables.
there's economic utility, of course, in having parties and having your friends over and playing air hockey.
True. So you made the move to Australia after that. Before we get into your career in Australia and the work you're doing at Sharesight, I'm interested to know your perspective, having worked in finance in America and now working in finance in Australia. What are some of the key differences you're noticing between the two countries?
Yeah, I guess the one big difference is the retail wealth management space, as we'd call it in the States, which is kind of like financial planning in Australia. The retail wealth management space in the US is so much bigger and so much stronger, and even on like a per capita basis. I mean, the whole concept in Australia of bank-aligned dealer groups and large institutions and investment platforms and superannuation, that is kind of turned on its side and has been for a long time in the States. And so that also means that investments like mutual funds are accessible to basically anybody in the US. I mean, it's sort of pre-programmed into your head. Like if you grew up, watching any kind of sports on television or anything like that in the States, it's all mutual fund ads. It's like a whale jumping out of the ocean, and it's all about stability and strength and blah, 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 blah. And I think that the minimum investments in these sort of like Fidelity funds or, Putnam or kind of these old school companies, it's about $500.
Wow.
And so you're always kind of trained to take a tax return if you get it, especially as a young person. It's commonplace in the States to get a bit of a return when you file your tax, to basically just whack that into what's known as an IRA, which is like a super. It's a tax sheltered retirement account, and just accumulate your savings there. You can pick and choose mutual funds. You can pick and choose shares to buy. It's a much more accessible and much more retail friendly investment market in the US. And also being the US, just the prices on retail goods, be they, trainers or be they managed funds, are so much lower. That is the main difference that I notice.
Do you think that's driven by pure volume though? Like there's just a lot more people over there, or is it fundamentally a mindset thing?
So I think it's volume. Volume is one thing. Like the scale of the U.S. economy is just incredible. But I also think it's because of superannuation. And this is kind of a weird paradox that I've noticed over the years of working in Australia. Super is a great concept. Like, don't get me wrong, I think it's awesome. But in an odd way, because it's mandatory, it's just everyone just thinks of it as super, right? Yeah. Like your money's just out of your paycheck pre-tax, and it just goes into quote unquote super, and it almost disincentivizes people from taking an active management role in their own finances, if that makes sense. And so I think if those institutions, like traditionally the banks, the big four in Australia, are kind of just hoovering up those mandatory 9.5% contributions from everybody in the country, there's not a lot of discretionary demand out there for young investors or even kind of middle-aged type investors in Australia.
The other big difference being that Australians just love to invest in property at the exclusion of basically everything else.
That's also very true. Yeah, for sure. Absolutely. And the other difference too, just specifically is dividends too, with franking credits. Dividend stocks are so much more popular in Australia versus the States.
Now, Doug, just on a point of terminology, I'm sure people are unfamiliar with the term mutual funds. So do you want to just, because it's not something that we have, or it's not terminology that we use in Australia. So do you want to just explain what that is?
Sure. So a mutual fund is the common term for a managed fund in the US. It's exactly the same thing. And you'd have a managed fund, in the States, you have a mutual fund, you have different share classes of the mutual fund. So if you're investing as a retail person or through an advisor, you'll come in through a different sort of sleeve, if that makes sense. And it's the same thing in Australia with managed funds. You can access a managed fund through your corporate super. You can access it through your financial advisor who might use an investment platform. But fundamentally, it's the same thing. And often it's the same global financial companies running strategies that these roll up into.
So, Doug, how would you define your investing philosophy personally?
Yeah, so I guess what I like to do is I use a bedrock of ETFs. And an ETF, just to define it, is exchange traded fund. But it's like a managed fund, but it just trades on the exchange and you can get in and out of them very quickly and they're very low cost. And there's an ETF really for everything. So if you want to track an index like the S&P 500 or the ASX 200, you can find an ETF for that. If you want to track a specific country, there's an ETF for that. If you want to track a specific sector or even a derivative, there's probably an ETF for that as well. So I build like a bedrock of ETFs, and I tend to favor global share markets. So I own, some S&P 500 via a couple of ETFs. I own an all world share market ETF. I own some ASX 200 through an ETF as well. And I kind of use that as the core of my portfolio, both on a discretionary basis and for my own super. And then I like to pick stocks that I know. So Sharesight is a software company. Specifically, we're known as a software as a service company, which is a subscription-based revenue model. And so I look for other companies like that as well, where I can look at their annual report and the terminology they're using and the metrics they're using make sense to me. So in a sort of a grand scale, that would be companies like Salesforce or companies like Atlassian.
Did you get on Xero?
Or Xero as well. Yeah, another great example. And I do own Xero, yeah.
Great stock.
It is a great stock.
Would have done well.
It is. It has.
So, Doug, you touched on Sharesight there, and I think this is a good time to get stuck into it. Now, I obviously gave it a big pump up at the start of this episode, but there are definitely people that aren't familiar with it. And if I'm honest, I wasn't familiar with it before our Equity Mates community started talking about it. So for people that don't know what Sharesight is, if we start very broad, can you tell us what Sharesight is and what it does?
So Sharesight is a portfolio tracking tool. So what we do is we help investors. You can plug in your accounts from various online brokers. You can upload information from spreadsheets. We've got tools that help you automate all of this stuff. Once you get your data in, we'll show you your true performance. So that's annualized performance of your investments. We'll show you the impact of capital gains or losses. So that's basically share price movements and the impact in your portfolio. We'll show you the return you've made from dividends. And we'll even show you the impact of foreign currency if you happen to own any overseas investments as well. So you can cut any kind of time periods you want in Sharesight. You can run attribution to understand who's contributing or detracting from your performance. And then you can run tax reports as well. So you could run capital gains tax reports, unrealized capital gain, and taxable income, i.e. dividend reports as well.
Now, the obvious question that arises is what's different with Sharesight compared to viewing your portfolio in your brokerage account or viewing it in a spreadsheet? So yeah.
Totally. Yeah, that's the number one question we get, like at events or, on Twitter or anywhere we talk to our customers. So the main difference with a broker, and this is really important. So if you use ComSec, which, half the audience probably listening to your podcast probably does, ComSec will show you a total return irrespective of any time frame, and they won't show you any information on dividends as well. So in my case, I own a company called Illumina, which is an aluminium company. I got that Aussie pronunciation right. I'm pretty proud of myself.
Nice.
It's an aluminium production company. And I bought it like in 2014. So if you look at ComSec, it'll show that my return on that investment is something like, 1,000% or 800%. But it's not. If you chunk that into annualized components, the return is much more pedestrian. And the other thing ComSec doesn't show me is the impact of dividends that Illumina has paid me as well. And then finally, with the brokers, most people, when they create a new brokerage account, they'll bring in money from elsewhere, right? So you'll bring in funds from an older brokerage account, or you may transfer them in from somewhere else. And that's known as a cost base. So having accuracy over your cost base is basically the same way as saying you need to understand what your starting point is to then track your performance from there. And if you move money into a place like ComSec, they basically say, okay, you're transferring in $10,000. That's your starting point. And so whatever money you have in there, they just assume that you've made a gain, quote unquote, of $10,000. And if you look at the chart, it basically does like a stair step up to your new value level, and they consider that as performance. It's not. It's just value tracking. Sharesight conversely shows you the impact of market moves, the impact of stock moves, the impact of dividends, and we smooth it all out for you to give you a much more accurate picture of what's going on inside your portfolio. And the same thing with spreadsheets, honestly. I mean, spreadsheets, they can be really basic, something even like a spreadsheet to track share price movements throughout the day. But again, unless you're licensing really expensive data feeds from the likes of Bloomberg or Morningstar, you're not going to be able to supplement that with the information required around things like corporate actions, like share splits and things like that, or dividends as well. We've seen some really fancy spreadsheets in our time. But again, it's that sort of bleeds into, well, how much of your own time are you willing to spend, building all these fancy macros and filters in a spreadsheet versus paying a relatively low cost for a service like Sharesight.
You should see some of Bryce's spreadsheets that he makes to track his personal expenses.
Well, it's funny you say that, Ren, because I am dealing with the situation that Doug just explained at the moment. I've recently changed brokers for part of my portfolio, and when you bring it in or transfer across, to Doug's point, it's just brought it in at a unit point of view. And so it says I'm in 100% profit on the total value of that. And so it's making my portfolio look phenomenal, where in actual fact I have...
It's shocking.
If it weren't for my immaculate spreadsheets, I wouldn't know what's going on.
Well, think about if you're kind of, one of our kind of typical users, you've been working in a professional capacity for decades. Perhaps you're, in your early 60s, you're getting ready to retire, and you've had like 6 broker relationships over that time. It's a huge mess. And the last thing you want to do is screw up your history, because you need to keep a close eye on that stuff as you begin to kind of live off of it into retirement.
So you're CEO, but it was founded by a father-son duo, Tony and Scott Ryburn. Pretty interesting story. Can you shed some light on that?
Yeah. So Tony and Scott, and they're still very involved in the company today. So Tony's director of ours still. Scott's our CTO. So they are from like an accounting and a software background. And these guys, they basically took Dad's problem, which was a very complex spreadsheet to track Tony's shares. And Scott said, all right, I think we can build something to track this. And I think we can do it in the browser. And this was like in 2008. So browser-based or cloud-based solutions of this caliber were not that popular. There's a lot of stock market, share market tracking software out there that you can download. And the problem with that is that it becomes out of date very quickly. You need to purchase licenses, you need to update data feeds and all that. And it's really not a great solution. And so Scott thought that he could build something in the browser, and they got some seed capital together from some early software developers, and they built a prototype. They're very much kind of accounting and software sort of background people. They ran this business really in a bootstrap kind of way in New Zealand, growing, steadily, but from a very small base in a very small market. And it wasn't until they attracted some capital from Australia and launched a version of the product in Australia that they began to really grow the business. And that's kind of how I came on board as well. But we're still very much doing the work that they sort of set out from day one at Sharesight.
So I use it because exactly the reason I just explained. And for a lot of beginner investors, it's certainly a tool that they should also have a look at. But is it a free model? How does it work for those, someone who might have 100 stocks? Can you explain that?
Sure. So it's a freemium model, and it's open-ended. So that means you can use the free version for as long as you'd like. So on the free version, you can track one portfolio and up to 10 holdings. So for a younger investor just getting started with a couple of shares, maybe a couple of ETFs, it's perfectly suitable, especially if you're kind of doing your own tax filing and your affairs are pretty straightforward. Where the limitations come in, though, are around number of holdings and portfolios. And so a typical, user of Sharesight, somebody who's paying us for, say, our investor plan, which is $25 per month, that person will be tracking 2 portfolios. They'll be feeding in trades from 2 brokers. They'll have about 35 to 40 open positions in their portfolios at any one time. And those guys, men and women, I should say, are typically sharing access with their accountant as well. So the accountant can kind of have a look to see if everything's in order and extract information when it comes to tax time as well.
Nice.
So Sharesight has had a pretty phenomenal growth story. It now tracks over 1 million holdings, and I'm interested to know what your vision is for Sharesight in the years ahead.
Yeah, sure. So, we've grown really well over the last sort of 3 to 5 years, and really the plan is to kind of keep at what we're doing for the foreseeable future. So we want to grow the business. We know we've got a lot more runway to grow in Australia, just given the appetite for self-directed investing here. But we're getting a foothold in markets like the US, Canada, and the UK as well. And so what we're doing now is we're building out product versions for those markets. When we kind of build a new country version of Sharesight, we need to ensure we track all the asset classes, all the data sets that people need. So is it a managed fund sort of setup? Is it a mutual fund setup? Is it various stock markets? This gets pretty complicated in places like Western Europe, where you're kind of investing on a global basis just by default. And then what we want to do is build out the tax reports as well. And that's pretty difficult, as you can imagine, when it comes to doing various capital gains regimes and taxable income regimes as well.
Yeah, I imagine you'd have a tax lawyer for every jurisdiction.
Yes, we do. Yeah, it's tough to do. But, we don't sort of give prescriptive tax advice, and we don't allow people to, connect Sharesight into the official tax filing, databases. So we try to get people really close and get them to a point where they can do it themselves, or just turn the reports over to their accountant and have them do it for them.
Speaking from personal experience, my last tax return, I have 3 different brokerage accounts, and, I was downloading PDFs and scrolling through and recording every dividend payment and what the franking credit was. And
You said you made it up.
if the ATO is listening, I did not make it up. But yeah, I can definitely see someone doing that and thinking there has to be a better way. And it looks like Tony and Scott did that. And
they did. And the thing about Sharesight is we're agnostic. So we don't care if you use 1 broker or 5. Brokers will develop good solutions over time, no doubt about that. There are institutional, financial software companies that'll develop really good solutions and have developed really good solutions, but they only speak to the clients and the client assets that they hold, right? They don't want to play nice with the rest of the marketplace because they're all their competitors, where we don't really care. We want you to connect as many brokers into our software as you can.
So, Doug, I'm sure that by the nature of what you do, Sharesight has a huge amount of data on how Australians are investing and sort of where they're putting their money. We're interested to know if there are any sort of particular interesting insights that you're able to share with us that perhaps we wouldn't necessarily be thinking about.
Yeah, so I don't know, if you look at the headlines, right? Like if you look at the Fin and you spend any time in kind of their wealth section or their SMSF sections of the paper, that's the Australian Fin Review, you'll see that it's often reported that Australians are sort of hopelessly underinvested in technology and they're hopelessly underinvested in overseas markets. And we don't really see that actually at Sharesight. Keep in mind that the data we can see is representative of people that have sort of sought out a solution, right? So by definition, they might be sort of more switched on, more sort of bleeding edge investors. But what we see is a real significant move towards ETFs. So if you wind the clock back 5 or even 3 years and you look at ETF usage among Sharesight portfolios, it was like 3 to 5% of trades or open positions in user portfolios. But if you fast forward to today, that number is about 18 to 20%. So there's been a huge adoption of ETFs amongst the investors using Sharesight. And a good portion of those ETFs are indeed your S&P 500s or your kind of your FTSE tracking ETFs as well. That's the UK-based stock market index. So we are seeing a shift to international investing, but I don't think it doesn't get picked up in the press because they still see that as an Australian-based investment because you're still buying an Australian-listed ETF, and they don't look through to see that the funds are actually exposed to overseas investments.
What about age groups? I'd be interested to know if you have view on that. And, is there particularly from a millennial point of view, are you seeing growth in that space, A, from just generally investing, and B, I'm assuming they're the ones that are kind of pushing this ETF growth, or?
Yeah, for sure. So we kind of have a barbell user base. We've got a lot of, as I mentioned before, kind of those folks that they're SMSF trustees. They're sort of approaching retirement. They're later in their professional lives, and they're really kind of avid users of Sharesight, kind of bumping up against the limitations of our highest level plans. And then we have a big cluster of younger investors as well who are kind of hanging out in the free plan. And they were the ones who really pushed us to do our ETF tax reporting as well, because ETFs have become so popular with that age group. And certainly I think a lot of the robo-advice companies that have launched are helping to push that as well, which we think is great. The more young people who can get into investing, the better as far as we're concerned. So we do see a barbell approach there. And the other thing we can kind of comment on regarding age is if you take brokers as a proxy for age, right? And by that, I mean, if you look at, say, ComSec, which is kind of the old growth of the share market in terms of the clients that have been using ComSec, and then if you kind of cascade that all the way down to sort of some of the new brokers that we work with, guys like Saxo or Stake, you'll see a very different sort of typical portfolio from the ComSec clients of the world to sort of some of these new startup brokers of the world. And really it's, you're looking at sort of your Telstras and BHPs and companies paying really juicy dividends for the ComSec guys. And then you're looking at international shares and ETFs for the new brokers and their clients.
So, Doug, one question that I'm sure a lot of people have, I definitely have, is, as people get more experienced in investing and as brokerages sort of internationalize and, give you access to more and more markets, the temptation is to move away from BHP and Combank and into, obscure Turkish managed funds and Eastern European miners and stuff like that. What's Sharesight's global coverage like?
So we cover, I think it's 28 different stock exchanges around the world. So pretty much every major stock exchange is trackable in our product. The managed funds is a bit spottier, but we're bringing more managed funds coverage on around the world. But that's kind of more of a function of the local demand in those markets. But from an Aussie perspective, you can track pretty much any stock in the world on Sharesight.
So before we close out with some of our favorite final 3 questions, Doug, we thought we'd just take a look at what's coming in sort of 2020 from either what Sharesight think or you personally. We've made a couple of bold predictions at the start of the year, but we'd like to know if you have any sort of big predictions for markets in 2020, especially given what has happened over sort of the last 7 trading days or so.
Yeah, man, I don't know. I can't believe it's already into March 2020 already. I would say, gosh, if I had to make a responsible bet, I would say more sideways action from markets. I just think this volatility is here to stay for a while. I mean, you see this whipsaw. I mean, not only the share market, but the oil prices. You know what I mean? With Russia and Saudi Arabia basically getting into like a sort of race to the bottom on oil prices, which is tied to all kinds of geopolitical stuff. And then, of course, you have the U.S. election coming down the pipe as well. So, no doubt that's going to create all kinds of gyrations in the market. And who knows what Trump's going to do or say. I think he's desperate. He's desperate to get the market under control because he sort of thinks that that's the only meaningful barometer on his presidency. So I just think more volatility, honestly. And, the election is all the way down the track in November. So more of the same, which is sort of, I guess, why it's so important to find, really high quality companies you're comfortable with now, because you can buy some of those at a bit of a discount. I mean, you asked the question earlier in the interview about, are markets over or undervalued? And even if you think they're overvalued, if you're going to invest for the long term, and I'm talking like 10, 20 years, you might as well take advantage of the dip, right?
Yeah, absolutely. I mean, I was looking at Google today alone and it's down 20% from its peak, and we were talking at work that it's not often that you'd be looking at their stock chart and having an opportunity to buy Google at a 20% discount from its high. So whilst if you do zoom out to that 3 to 5 year, it's still awfully high. There's certainly some opportunities out there.
Yeah, well, I mean, we missed the GFC. Well, we were both in high school still, but, we weren't investing at the time, and we've lamented that for years, that was the golden buying opportunity. And as much as it's not a great reason for us to be here, it's making lemonade when life gives you lemons. How about that?
Yeah, totally. Yeah, well, I was lucky in that too, because I had just moved to Australia when that was all hitting. And of course, Australia fared pretty well through that whole thing. So I don't think I was appropriately scarred either. To
close out the conversation around 2020, and don't worry about making responsible predictions. Bryce and I make very irresponsible predictions. Do you have any sectors, any industries that you're watching, or any themes that you think are really playing out that you might be paying more attention to than the majority of the market?
So I mentioned before software, obviously, but then within software, look for those SaaS companies. What I love about SaaS is that it combines a very old school business model, like subscriptions, which is like, the newspaper business essentially, with technology. So I really like that. And there's a lot of publicly listed SaaS companies out there. And the other one I think is probably healthcare. I guess going back to kind of the discussion on coronavirus and all that, but also an aging population, right? Like people are living so much longer. And nobody really talks about the financial impact of that. Nobody talks about investing until 100 years old. No one talks about how the heck do you draw down a super over 20 years longer than it was designed to last. You know what I mean? So how does that play out? And how will healthcare companies themselves respond to that? I mean, is it an opportunity for them? Will it be too much for them to handle? I own a healthcare ETF, which I kind of actively check on, just kind of regarding that space.
Yeah, it's a good point. I think it's something that is going to hit governments quite significantly, and to your point, doesn't feel like it is being talked enough, at least in public domain anyway. To close out our interview, Doug, we always have 3 final questions, but before Ren kicks off with that, I'd just like to at least let our equity mates community know that Sharesight, you guys have hit us up with a bit of an offer for any of our community who are looking to get involved a bit more seriously with Sharesight. As you said, you can sign up for free and can have up to 10 holdings tracked, which is awesome for anyone, to your point, Doug, who has just a couple of ETFs or maybe is just starting on their journey. And it's a great way to bring all of that together and get a true reflection of how your portfolio is going. But for those that are looking to take that sort of next serious step, if you head to sharesight.com/au/equitymates, there's an offer there that will give you 2 months free when you purchase an annual premium plan. So a pretty good offer considering the value that you will get out of this, not only from an ability to track all of your shares in one spot and get a true display of what's going on, but also the ease that you'll get at tax time as well around the reporting side of things. So A, sign up for free and start tracking. And then B, if you're looking to take that next step, head to sharesight.com.au/equitymates, and there's an offer there for 2 months free.
No .au, just .com/au. What we might do
It'll
is
revert to it.
we might chuck the link in the show notes as well. So if you're not following Bryce's spelling out the link, just click on the show notes for this episode and you can just hit the link.
Absolutely. We've also put this link in our Facebook group multiple times. So if you are looking for it in there, check it out. I would say the majority of our community are in Sharesight in one way or another.
So Doug, as Bryce said, we like to close out our interview with the same 3 questions every time. So we'll get stuck into that. The first question is, do you have any must-read books? And these can be investing or otherwise.
Oh, man. All right. So investing, I would say a book that really helped me prep for my interviews when I started my career in finance was A Random Walk Down Wall Street by Burton Malkiel. That's a really good kind of grounding book on what does and doesn't drive returns for investors. And the other one I would say, which is a bit more of a narrative, is The Snowball, which is a biography on Warren Buffett. And
great book.
Buffett is such a cliche in terms of investing and investing stories and all that, but he's a cliche for a reason. And he has just an unbelievable ability to make complex things easy to understand. Yeah. And his story is incredible. And you'll learn about why he fell in love with insurance companies, which seems really boring on the face of it. But then when he explains it to you, vis-a-vis the writer, it makes so much sense. And you're like, oh my God, insurance companies are the best business models in the world. So it's an awesome book. I would highly recommend that. And you can get, you get little snippets of that too in the Berkshire annual reports and his letter, which they publish on their website. So you can download those as well. On the non-investing side, I kind of go back to the classics. A book that I've just picked up again is Catcher in the Rye by Salinger. So I go back to that. That was kind of a staple of American high school literature, but it does a good job with sort of, with the protagonist of talking about sort of outcasts and people who go against the grain. And I think some of the best investors in the world are people that do go against the grain. I think some of the best people working in software are people that go against the grain as well. And, if you find yourself in a position where you're working in software and you need to kind of manage different talent and things like that, I don't know. I think it's helpful to kind of look at the world through that lens too.
Great. So the second question that we like to ask is, what's your go-to source for investing information?
Yeah. So I go to Morningstar for fundamental research and recommendations. And then obviously a big asterisk there. I worked there for a long time. I know I know their process. I'm not getting paid for saying that, I swear. But they do a good job, and I've seen it with my own eyes. Their analysis is absolutely objective. They have analysts there. They spend a lot of time evaluating companies and manage funds, and they don't get paid based on their calls. They're not incentivized by investment banks or anyone else with a skin in the game. So they do about as good of a job as you can do on that front. And the other one that I go to as well, honestly, for kind of quick hit info is just Bloomberg.com. I mean, if I want to check, the stock market or whatever, I just like their UX and the speed of their site, basically.
Same. So easy.
And then the last question, Doug, to close this out. If you think back to your early days investing when you were buying Disney shares and winning Illinois State investing comps.
And buying hockey tables.
What advice would you give to your younger self?
I would have lived at home for longer to save more money to invest. I basically borrowed money from my dad for the deposit of my first apartment in Chicago because I couldn't wait to get out of there. But in retrospect, I had it pretty sweet at home. There was food around, rent was free. And on a relative basis, I would have been saving a heck of a lot more money that I could have invested or done something else with.
Unfortunately, Ren's just moved out of home, so lucky boy.
Yeah, it's different in Australia. People stay at home forever. I think this is we've got a 5-year-old and a 2-year-old, and my wife keeps talking. She's like, "Oh, I'm so excited. The kids are never going to leave," and it sounds awful to me. But
I got to say, I moved out when I was 18 and then moved back in when I was 27. And moving back in, you do save a lot of money, but it's a hard readjustment to go back.
Especially if you've just moved out. I think the average age in Australia is something like 31 or something ridiculous.
Really?
Yeah.
Jeez.
But that's with a move out, move back kind of.
Okay.
Go to uni, come back.
So I'm skewing the average is what you're saying.
Yeah, exactly.
Well, Anyway, Sydney's awfully expensive, so I get that.
That's why Bryce and I both moved to Canberra. The only way we could move out.
Smart.
University. Doug, really appreciate you spending your time with us for the last hour or so. It's been very enjoyable talking to you, and I hope we have managed to kill the appetite for all of our...
Not kill the appetite, spark the appetite.
Well, I mean, for everyone continuously asking us to get Doug on the show. It's been great for you to come on and, I guess, share everything that is Sharesight, and we know personally it is a great product, and as we said at the start, you know, Ren was super pumped. Our community also find a lot of value in it. So I guess just a thanks from us for such a good product and also sharing your time with us today. So look forward to getting in touch later in the year, and big thanks.
Oh, thank you guys so much. I really appreciate the time, and thank you so much for having me on.
Thanks for listening to Equity Mates Investing Podcast, a production of Equity Mates Media. Please remember that everything you hear in Equity Mates Investing Podcast is general advice only. The content has been prepared without knowing your personal objectives, specific financial circumstances, or goals. The host of Equity Mates Investing Podcast may maintain positions in the companies discussed. Before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.